Hi, good evening. Let us understand the difference between portfolio management services and mutual fund. In case of PMS, the portfolio size is concentrated across 20 to 25 stock, and the strategy is very simple. Entry during the strong bull phase and exit during the market correction. Whereas in case of mutual fund, the portfolio size is a diversified portfolio spread across 60 to 70 stocks. While investing in PMS, we need to understand some additional costs involved, like invisible costs, such as annual tax drag, which ranges from 2 to 4%. For example, if an investor is into 30% bracket and if his portfolio is churning at 60%, then depending on the profitability, his annual tax drag would further increase. Similarly, another invisible cost is total cost of ownership, which ranges from 1 to 3%. Another invisible cost is TWR versus XIRR. TWR stands for time weighted return, whereas XIRR stands for extended income investment rate of return, which ranges from 2 to 5%. Time weighted return measures the strategy performance. Let us understand what are the invisible costs which are involved in case of mutual fund. The total expense ratio is the cost as it covers the management, admin, and transaction cost. Another parameter which needs to be understood while investing in PMS is tax at every transaction. Since PMS is a direct ownership entity, hence every buy and sell, whenever it is executed, it will call for taxes. Short-term capital gain is triggered immediately. If 60% of the annual churn happens on an annual basis, then this will add to the strategic the short-term capital gain. Fee not deductible. The management fees and GST cannot be offset against the capital gain tax. No tax deferral. Unlike mutual fund, there is no mechanism to defer the tax liability. Let us understand what happens in case of mutual funds. Fund manager can churn the portfolio at any frequency. The entire pre-tax corpus continues to compound since the tax is applicable only at the time of exit. Internal portfolio churn doesn't create any tax event. So with this comparison, is it advisable to invest in PMS? Yes, of course, provided we meet the four important conditions, like we need to have a portfolio size of 5 to 7 crore plus. Uh, One should be a ultra HNI who has the ability to evaluate the fund manager and their strategies. Then the investor has the capacity to absorb volatility, which would be large. And most important is alpha, whatever is being generated by investing in portfolio management services should be able to offset the invisible cost and the tax. So with this, we are able to judicially take a call whether one should invest in EMS or invest in mutual